Good morning. Today is Wednesday, June 4th. I'm Joe Terril, president of Terril and Company, private wealth managers in St. Louis, Missouri, with approximately $870 million of discretionary money under advisement. And today is another update on our investment thinking and what we're doing with clients. We appreciate you tuning in. I want to welcome our longtime 13-year associate at Terril and Company, Tricia Warner, who has over the years done both administrative work but also investment work and has helped us with research and etc. And as we've grown and we have very fine Laura Roy, who is now doing most all the administration. We're enlisting Tricia into doing more on investments and etc. So Tricia, welcome to you. I thought what we ought to do is start talking just in a roundtable discussion about the economy. And Tricia, I'm going to ask you to start because I know you were overseas doing a little bit of work and a little bit of vacationing, as well as back domestically in the United States. And just chat about, if you will, for our viewers, what you saw.
Well, I just got back from the UK and it was crowded. Everywhere you went, the planes are packed, the restaurants, people everywhere. So I'm just amazed. I can't believe how, and it's people from all over the world, not just the US, but languages I don't even recognize. So it's very busy, lots of money being spent. So
It fits in, I think, a little bit, you know, with what we're saying. For whatever reason, the consumers around the world, they say they're worried maybe about tariffs, they're worried about the economy, but they're saying one thing and doing another. Dave, we were talking yesterday about the Atlanta Federal Reserve Bank GDP figure. Just tell our audience what that figure was, and even if there's some seasonal adjustments or whatever in there, again, it's showing the economy being very resilient and strong.
Well, it came out yesterday at 4.6 positive. It's a volatile number. There's no question about it. And it takes into account imports and exports and that, but you back out and sort of normalize it, it's, you know, plus 2.8% on a GDP growth basis, which is very solid. I'm surprised on how strong the economy is with the inflation numbers. You know, taxes are up, insurance is up, and things like that. But you know, people are out and about, and it doesn't seem to slow them down.
Well, it means that our overall investment philosophy, because the strength of the world economy ultimately can have a lot to do, as we all know, with the rate of inflation, interest rates, and ultimately investment markets. But I think I'm going to turn, Rush, to you and Bill, and maybe tell our viewers what we've been doing a little bit of recently. We're making money, we're doing well, but how are we relating this to the investments that Terril and Company is making for our client portfolios?
Well, I think we continue our solid investment philosophy, looking for ideas, especially on the equity side, that have pulled back. I agree, I don't have the international travel experience some of you guys have, but the economy's strong, people have jobs, they're spending money. As David said, he was surprised. I'm not surprised. When the St. Louis airport is as busy as it has been, it's never busy, that tells you something. I tend to think that some of this tariff concern, especially at least for now, is noise. You see people looking through it. You see people continuing to spend money. I think People are waiting every time Trump puts out a tweet on X, when is he going to blink? And he's done that several times. The other piece of this, which ties in, Joe, with the equity side, is we continue to believe that rates are going to be higher. I'll give you the perfect example. Money is still easy to get. I just refinanced my home equity line. I locked in 12 months at a 4.99. It was over 8%. I think it was close to 9%. Money's still easy. As far as specifics on stocks, I'm going to let Bill cover it, but what I will say, the April 7th lows that we saw really once again have been driven by those TAC Mag 7 stocks, and Bill has some
Very
good
true.
statistics on that.
Yeah.
Thank you, guys, and greetings to all of our clients. We're glad you're joining us. Perhaps just a step back to reiterate what Russ and Joe and the others have mentioned. So the April 7th low in the S&P was 4,835, and let's just call it 2 months later, we're basically back to even or maybe up a little bit on the S&P. But the Magnificent Seven stocks are responsible for 50% of the rebound. So when we look at the market, it's still very risk concentrated. There are just a few names driving the outperformance. So these are all about flows coming back into these names to drive this rebound. Now, when we look at our investment philosophy, we want to stay disciplined, we want to stay focused, and so just some highlights of some names that we've been doing. We still find Verizon very attractive with a 6.25% yield, so we like that as a value name. We've been buying Warner Brothers Discovery, which a lot of people will recognize that brand name. It's a really nice debt pay down story. They've also got a streaming business that's expanding quite a bit internationally. And with the media and content names, there's always some merger and acquisition override. So that could be a catalyst as well. And then we mentioned names that we have sold and that are buying back now as kind of this market volatility. We've been re-entering positions in Globus Medical, which is a medical device firm that specializes in spinal and orthopedic surgery. And so we had sold it late last year, early in 2025. The stock pulled back on some merger integration issues, and now we find it attractive, so we have been reestablishing positions in Globus Medical.
They'll say something nice. We're buying it back, what, 25
Yes,
points lower
Yes,
than where we sold it?
Right, we did sell it quite a bit higher, and so we look to do that, right? We understand the name, we understand the acquisitions they're making, we like the management team's long-term discipline. So for us, growing the business and doing it the right way was a really positive catalyst for us to get back into the name, and as Joe mentioned, again, $25 cheaper than where we sold it. So
One other name, Joe, that I would add in there is Mosaic. Mosaic was a name in the fertilizer space that was kind of left for dead, and nobody liked it, and now all of a sudden everybody likes it. So Mosaic is another name in the portfolio that we've owned and been very successful, and performed well for us.
Yeah, it's back to $37, but you can certainly make the case that there's plenty of room to run there. It's a little bit of a complicated story for our viewers because it's a Canadian company. They're the second largest fertilizer producer in the world, but the stock got way too cheap, and we were able to take advantage of that. And then just real quick on the fixed income side, there are opportunities that come up that we take advantage of. UMB Bank last week sold an issue at 7.75% that in 5 years they either pay you off or it'll reset at 3 5/8 over whatever a 5-year treasury is paying. And we like that structure very much. We continue to, every time we can find one of these that offers value, do it with the theory that I can live with 7.75, particularly in individual accounts, you get the tax advantage of not paying full tax on the dividend. And in 5 years, 3 5/8 over the 5 year, that'll work, and that'll end up being okay.
Yeah,
So-
you double your money in 10 years at 7%. I'll take that.
Well, anyone want to make any more comments about things? If not, let's stop there, and we'll be back in 2 to 3 weeks. Thank you, Brian Curtis, for helping us produce our updates. And remind me, Brian, what it was. We want to encourage people to go to YouTube and click something,
You want to
or
like, share, and subscribe to our YouTube channel, and also hit the notification bells whenever we come out with new YouTube videos. You'll be notified.
okay. Thanks to everyone for tuning in. We'll be back as needed or in another 2 to 3 weeks with updates. Thank you.